Hello and welcome to week 5. I hope everyone is doing well. This week we have chapter 12 and 13 to read. You have your homework problems, you have an individual finance paper, and also a brief forum discussion. So I kind of pick up the pace a little bit this week. But if we look at chapter 12 there, very beginning of the chapter, you see William Sharpe there receiving the Nobel Prize in Economics. And William Sharpe is kind of the founding father, if you will, of the CAPM model and this idea of using beta and the difference between the market return and a risk-free return to establish an appropriate rate of return for an equity or a stock. And eventually this will lead to chapter 13, where we figure out an appropriate opportunity cost for the corporation for its investors. How do we actually come up with this interest rate or discount rate when we discounted all these projects for net present value? So some things I want to point out in this chapter. First, just starting with the concept of beta. Beta is a measure of volatility. So it says, for example, for McDonald's, perhaps if they have a beta of 1.2, if the market goes up 10%, then expect McDonald's to go up 12% in their returns on average. Or if the market goes down 10%, then McDonald's would be expected to go down 12% over average. And basically what we're doing is a simple linear regression, looking back over a period of time for maybe the return over a series of months to see how did our company do compared to the market. And again, our company is the dependent variable and the market is the independent variable. So you could do a linear regression that kind of measures as the market changed, what happened to my company's stock's returns. And if the beta is large, it says that, hey, there's a lot of volatility here. I'm taking on more risk, and as an investor, I want to be compensated with a greater return. It doesn't guarantee that I'm going to get that return, but when I'm thinking about discounting projects, this is going to impact our opportunity cost for the company. In fact, on page 342, they have an Excel example of how to calculate that beta. There's an example that I have out there on the video, but I encourage you to walk through that and kind of look through the different examples for the chapter. They have on page 344 some examples of other betas based on, it says 5 years of monthly return. So that's a pretty good time period to measure the volatility of a company. You could also have a portfolio beta. You could look at all the stocks in your portfolio, what is each beta associated with that stock, and then look at a weighted average, if you will, for your overall portfolio. What we're ultimately getting here in this chapter 12 is that security market line and kind of that concept of the capital asset pricing model. But on page 354, you can see the basic formula there on the bottom of the page. It says, hey, we got to take the risk-free rate, which is typically a treasury bill or a treasury note. And then also we take the beta times the difference between the market return and the risk-free return. And this, in theory, gives us an appropriate rate of return on that equity. So if a company is all equity financed, they could just use CAPM. But as we look in the weighted average cost of capital next chapter, it's really a combination of what is our capital structure? Is it composed of debt? Is it composed of equity? Is it composed of preferred stock? Okay. Well, let's look at our next chapter here, chapter 13, and we get into the weighted average cost of capital. When you read this chapter, do take it slow, because there's a lot of technical reading in this chapter, and they have a lot of symbols for a lot of the things as the required return on debt, the required return on equity, beta. So slow down a little bit, make sure you understand everything, and read the examples. But with the weighted average cost of capital, kind of start off on page 369, you see these two pie charts. How much is the company composed of debt? How much is it composed of equity? And that's going to be our first part in calculating the weighted average cost of capital. What is the weight of debt? What is the weight of equity? Because we're going to multiply that weight times whatever the required rate of return is on the equity and the required rate of return on the debt. The one thing about the debt is what we have is called the after-tax cost of debt. Just at this time of year, you're going to start doing your taxes. Perhaps some of you are going to itemize and deduct the interest on your mortgage. Well, let's say that you have a mortgage of 5%. If your tax rate is at 25%, what you could do is take the 5% times 1 minus 0.25 and figure out what your true after-tax cost of debt is. That is, that you get some benefit from financing with a mortgage because you get to deduct the interest expense. It doesn't mean that you don't pay that interest. It just means that it saves you money somewhere else. It saves you not paying Uncle Sam in federal taxes, so that's where the tax benefit is. And that's what we use from the investor's perspective for the debt piece, is the after-tax cost of debt. For the equity piece, there's a lot of ways we can look at this, but primarily we're going to look at the capital asset pricing model to find out what is the required rate of return for that investor. So when we look at the weighted average cost of capital, we're kind of saying, hey, if we're 50% debt finance and 50% equity finance, I'm going to find out the after-tax cost of debt first, then multiply that by 0.5. Then I'm going to figure out the capital asset pricing model. Say if that's 10%, then I'm going to multiply that by 0.5, and then I'm going to combine the two together to figure out what the weighted average cost of debt is. And I think if we look at, on page 379, they kind of give us a simplified example in the middle of the page there, but they show the after-tax cost of debt calculation, but the 12%, the CAPM is just kind of given to us, so it's like somebody else has done the grunt work. The last thing I want to point out in this chapter, this is on page 382 and 383, is in valuing the entire business. And this kind of gets down to really what we're trying to do in stock analysis is what is really the true value of this stock. Am I overpaying for this stock? Is the stock underpriced and it's a great deal and I should buy it? What analysts do, those that try to figure out whether we should buy a stock or not buy the stock, is they project out for many years, in this example 6 years, what they think the income statement's going to look at. It's just a projection. These things can change daily, and kind of in theory, in the fundamental analysis, if the model changed and sale forecasts change, then the value of these cash flows are going to change. But what they've done is they've discounted back all these free cash flows, and especially in the sixth cash flow, they kind of use the concept of a perpetuity. They call this horizon value, where they take the last year of 79.5 million divided by the required return minus growth rate, and that's how they're coming up with that $2,271.4 thousand. So if we look at the top of page 383, you'll notice that the last one, the 40.2 and the 292.71.4, are discounted back for the fifth year. So it's kind of like we have to combine these two together, and then we can discount them back if we're to use net present value. But once I know what the value of all these cash flows are, I could divide that by the number of outstanding shares and see, hey, what should the price of the share be? And if it says that the value of the share should be $75 and it's only traded in the market for $50, well, that would tell you, hey, I should be buying this stock. But if it's the opposite, then nope, we should sell this stock and get out. So once you have a great week, do email me if you have any questions. But remember to kind of go back and look at that previous video for the equivalent annual cost paper you have to do. But again, email me if you have questions. Take care and have a great week.